Ladies and gentlemen, welcome back to the channel. Tomorrow has the potential to spark a rally in AMC stock in which you have not seen in a very long time. Now, I want to go over my expectations, what I believe is going to happen coming tomorrow. Now, this is far from a guarantee. Anything can happen. Be expected for, or be expecting the unexpected, but these are my expectations. Now, as you probably already know, we get the Fed meeting tomorrow. Now, the Fed meeting has a lot of potential outcomes, but I think, as I've said before, the writing is on the wall for this one. Hit that like button as well as subscribe to the channel. Let me know what you think about this information down below in the comment section, and let's get into it. So, first things first, it's important to know, again, I'm not a financial advisor. I'm not a financial planner. I'm not a fortune teller. At least I don't think I am. And I am subject to obviously be wrong. So do not trade, invest, speculate based on anything that I say in this video or any other video. With that being said, the Fed is going to give us the report coming at 2 p.m. tomorrow. Now, this report may or may not contain important new details. Typically, this speech does not change much. Sometimes the Fed changes the language in which is actually, said in the speech itself. And this is what the document looks like. This is the last one that came out December 13th, 2023. It reads something like this. Recent indicators suggest the growth of economic activity has slowed from its strong pace in the third quarter. Job gains have moderated since earlier in the year but remain strong, and the unemployment rate has remained low. Inflation has eased over the past year but remains elevated. The Fed just changes little words here and there, and that's what the algorithms kind of comb through, and that's what moves the markets coming at 2 p.m. Now, tomorrow, I believe there is a chance in this statement you will see language along the lines of recent data suggests that the Fed should or could consider reducing the pace of their balance sheet runoff or ending quantitative tightening. Something along those lines is what I'm expecting. And I think that's going to be the main story of tomorrow. I do believe the Fed's going to leave it kind of open-ended, at least in the actual report that comes out at 2 p.m. itself, about actual Fed policy. So I'm not expecting any kind of rate cut tomorrow. I'm not expecting a rate increase. But I do think the quantitative tightening is definitely going to come up in that 2 p.m. report, and I think it's going to essentially say that the Fed is soon going to stop the runoff of their balance sheet, or at least reduce the pace of their balance sheet runoff. And that's the important part. Now, in regards to Fed policy specifically, if you look at March 20th, markets, they're no longer pricing in a rate cut coming in March. The expectations of a rate cut are 38.5%. The odds of a pause are 60.7%. So there's like almost no chance unless we get the Fed just outright saying, hey, we're going to cut rates, or unless the Fed says, we're going to change policy in one capacity or another. I don't think the markets are going to care much if the Fed says, yeah, we're thinking about cutting rates maybe in May or beyond, or in the second half of 2024. I don't think the markets are going to be too surprised based on that, because that's kind of what we're pricing in as of right now. So I do think that's better than not. The fact that we're not pricing in a rate cut in March, it does give the markets a little bit more wiggle room for maybe a little more hawkish Powell coming tomorrow. Now, I don't believe Powell's going to go full hawk. Indeed, I think the markets might actually take tomorrow as very, very bullish, because essentially, when you look at something like a TLT, this is the ETF that tracks the 20-year Treasury. It's relatable to the 10 and the 30-year Treasury as well, really the long end of the curve. Now, Janet Yellen came out yesterday and said the Treasury is probably not going to have to issue as much debt as they previously thought. And that's what has kind of caused TLT to rise. But when you think about that, why would that be? Well, they would only have to issue potentially less debt if bond prices went higher. So the Treasury has had to issue massive amounts of debt because Treasuries are so low, right? And the yields are so high, which is a bad situation overall for the government. But if theoretically Treasuries were to rise, maybe the Treasury wouldn't have to issue as many Treasuries. Now, as you can see, TLT is up 0.5% today, heading into the Fed tomorrow. That's a pretty large move pre-Fed. Now, you can also see we did fall in the beginning of trading on TLT. You caught a bid towards the low of the day, and then you started working your way back up to where we currently are on TLT at $95.28. So I think that's pretty interesting that bonds are actually rallying into the Fed, which does, paint the question for me is, do the bond market investors already know an end to the balance sheet reduction is coming? Now, JP Morgan has speculated the end to balance sheet reductions could start by March or May, but general consensus is there's not really going to be a change to the Fed's balance sheet runoff. So if that were to happen, that would really catch the markets by surprise, in my opinion, in a good way. Now, something else that also has me leaning towards a shift here in the Fed's reduction of their balance sheet is XLF. This is the ETF for the financial sector, really incorporates your big banks. This thing is hitting a new 52-week high today. Now, who stands to benefit the most if the Fed does stop reducing their balance sheet? The banks, because the banks, think about the banking crisis. They're in a pickle, a bit of a problem, because TLT has fallen so much. This is just representing the face value of the bonds, the dollar amount of the bonds. You're back to levels you have not seen since, 2012, 2013, 2014. And that's a problem when most, banks were flooded with capital over the past couple of years, and they had to deploy that money into, you guessed it, the bond market. So you could see this chart has been on a downward slide for the last better part of, 4 years now. Well, a lot of that has to do with, again, the Treasury, selling a lot of bonds to fund the government's, spending spree, but also the Fed reducing their Treasury holdings by $60 billion a month. If that were to end, Treasuries can probably get some support here and probably start to rise, which will mean Treasury yields actually fall. So long story short, I do think the Fed is going to signal an end to quantitative tightening coming in March, and I think they're strongly going to signal that. And then what happens from there is 10-year Treasury yields likely fall as people start to go out and buy the longer duration bonds. So it sounds complicated, but really, the point is this could be very bullish for markets as 10-year Treasury yields do fall coming tomorrow. That is my expectation. Now, a couple reasons I expect that. Number one, the Bank Term Funding Program, which we've talked about this a couple times here on the channel. The Bank Term Funding Program is being utilized at an all-time high right now, and the Fed just came out and said, we're no longer going to issue loans via this program coming on March 11th. Now, the next Fed meeting after tomorrow is March 20th. So if the Fed did plan to implement that, change to their balance sheet reduction, that would, tomorrow have a positive impact on the banks and on their balance sheet, specifically on treasuries, because that would cause TLT to rise again. And let's say banks bought bonds in the, when they were 130 to 120, 140-ish. Well, if TLT starts to rise, your unrealized losses are going to become smaller. So it would not make sense to give out loans, to banks via the Bank Term Funding Program if their bond portfolio started to actually recover. Because that is what the Bank Term Funding Program is. If you are a bank that spent $100 billion, let's say, on bonds at 120, now they're $95. If you don't want to go out and sell those bonds and realize a loss because let's say you have another bank that wants $100 billion back from you that they lent you or whatever the reason is, the only way that you don't have to sell those bonds is if you go to the Bank Term Funding Program and you say, hey, Fed, I have 100 billion worth of bonds. You're going to get all of your money back in 7 years when these bonds mature, because we bought them 3 years ago and now they're upside down. Will you just give us the full value of the bonds back, and you can hold them for the next 7 years, collect the interest payment, and keep those bonds as if they are yours? And then the Fed says, yeah, sure, why not? You have these assets that have depreciated because we've been raising rates. We'll just hold them for until maturity. You can have your $100 billion back today and go do what you will with that. So I think that's important to understand, and I think it's important because TLT is up 0.5% today. The banking ETF is literally hitting a 52-week high today. I don't know what other clear sign there is than this, that you're likely to see Treasury yields fall big time coming tomorrow. If Treasury yields for whatever reason do rise, I would be very surprised based on that. Like, very, very surprised if Treasuries are up coming tomorrow. Now, if you take a look at 10-year Treasury yields today, you're down about 1.5 basis points. Not a crazy big move today, but if coming tomorrow, I expect 10-year Treasuries could fall as low as 3.9%. You could see a 17 basis point fall tomorrow if I am correct on what I expect, and that is an end to quantitative tightening, or a very strong signaling that the Fed is going to end that soon. The other reason why I do believe the Fed basically has no choice but to end the quantitative tightening cycle they've been in, because look at the excess deposits at banks. This is the overnight reverse repurchase agreement market. So banks take their leftover money. If they don't want to buy long duration treasuries or short duration treasuries, they'll go park that money with the Fed. You were sitting at, even just as recently as November 15th of 2023, at about $1 trillion. And now you're at 581 billion. You're way lower just in the last couple of months here on this fund. Even back in August of 2023, you were at $1.8 trillion. That excess capital is gone. So maybe the Fed does not outright stop quantitative tightening. Maybe they start reducing that to maybe $10 billion a month. Maybe it goes from 60 billion to 10 billion. That would still have the same desired effect in pushing bond prices up and yields lower, as you're now no longer seeing the markets continuously being flooded with this supply. Now, coming tomorrow as well, you are going to get Janet Yellen announcing what the actual selling process is going to look like for treasuries over the next 3 or 6 months or so. And the news that we got yesterday that helped out the treasury market is the treasury may not need to sell $55 billion of bonds in which they previously thought they were going to need to sell. So basically less selling of treasuries, less pressure on pushing yield higher. So it looks like the combination of these things, I mean, the writing is truly on the wall, in my opinion, for this. Now, what kind of effect could this have on AMC? Well, if treasury yields start to fall, investors start to buy treasuries, then your risk premium becomes more attractive investing in stocks. In other words, if you can get 4% in a 10-year treasury, if you can make 40% over the course of 10 years and get all of your money back risk-free, then why speculate in AMC? Why speculate in Microsoft? Why speculate in Tesla? Why speculate in Crocs or Fubo or SoFi or any of these other stocks that maybe have not performed well? Yeah, that doesn't make sense if you have a fiduciary responsibility to protect people's money and to help them grow their money. You're not going to do that. If 10-year treasury yields are paying you 3%, buying a Microsoft looks more attractive. If treasuries are 2%, then yeah, buying a Microsoft looks really attractive, because you're not even going to beat inflation over a 10-year basis if you're only getting 2% a year, or you're at best going to break even, right? So your risk premium looks a lot better. So the closer you get to 3% or 2%, because in reality, if the Fed's targeting 2% over the longer term, and you're getting 3% on a 10-year treasury, or even 3.5% on a 10-year treasury, let's say 3.5%. Over the course of 10 years, you're going to make 35%. Well, if inflation's 2% over the course of 10 years, you're going to make or lose 20% based on inflation, what does that leave you with? 15% over the course of 10 years. If Microsoft just did 15% in January, yeah, your risk premium, it looks a lot better, in other words, to go out and buy a Microsoft or go out and buy stocks. Now, again, how is this positive for AMC? Well, your sectors of the markets that have really not seen any love or attention for the past 2 years now are your small and mid cap stocks. A stock like an AMC. Now, as rates do go lower, you have $6.2 trillion of investable capital in money market funds that likely starts to get deployed back into some of your small and mid cap stocks. This is partly the reason why your portfolio has probably not done so well unless you're in Magnificent Seven. The average stock has actually not done so well. Look at a Whirlpool, for an example, in the gutter. Look at, a Target, a Dollar General. Some of these well-respected names have not been doing well. Part of that, you could say, is the businesses have not been performing as expected. The other part of it, you could say, is there's just no capital in this market. There's no inflows to this market. Nobody's buying stocks anymore. And that is a big problem because, if nobody's buying stocks, well, really nobody's going to be buying AMC. So as capital comes back into our markets, it opens the door for capital to get invested into a stock like AMC. Now, precisely around the time you guys are watching this video, we will be getting earnings from Microsoft, AMD, Google, better known as Google, but Alphabet, technically, Starbucks, Skyworks, Juniper Networks, Match Group, Lending Club, EA Sports, To The Game, Electronic Arts, and CP. So these companies will obviously be important. Microsoft is by far the most important stock for this earnings season, largest company in the world by market cap. If they have not so great numbers, well, that's not going to be good. It's really going to be about forward guidance and the AI story. I think there's a lot of high expectations here, so there is a tough bar to beat. It's not like we're in a low place. You're expecting like 15% year-over-year revenue growth to $61 billion. Best quarter ever for Microsoft is essentially what we're expecting. Coming off of a big beat of Azure cloud services last quarter, it's really setting you up in a precarious situation where it's going to be pretty hard to impress investors at this moment in time. So depending on how those earnings obviously come out, that will affect markets also heading into tomorrow. But the big story is the Fed, and the big story is, in my opinion, quantitative tightening or quantitative easing. What is the Fed's plan with the balance sheet, and how does that move interest rates? Does it move rates lower? If it does, that's going to be very bullish for AMC stock because it will bring money back into our markets. It will make it more attractive to invest in something like an AMC. Now, if you take a look at short interest percentage of free float, 10.97%. That has also been increasing as of lately. $117.31 million worth of short positions currently in AMC stock. Days to cover 1.46. 27.47 million shares currently sold short, 26.89 million shares currently out on loan, cost to borrow 1.09%, utilization of 37.13%, and a short score of 59.52 out of 100. If you take a look at the cost to borrow fees at about 7.25%, so a decent amount of activity around shorting AMC stocks. So the shorts have definitely not given up just yet. Percentage of stocks today above their 50-day moving average getting destroyed today, down about 6% to 64.77%. You're way off of your high of 86%. So if your big tech names that are coming out right now do not perform and do not impress investors, you're going to be in for one hell of a problem in our markets. But tomorrow, the Fed, well, that's going to be the big story. That's going to make or break our markets for the next foreseeable period of time. Hit the like button. Subscribe to the channel. Let me know what you think about this information down below in the comment section. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.